We've all heard horror stories about how assets end up in different people's hands because beneficiaries were not updated or estate plans were done incorrectly. Or the person that took money prematurely out of a retirement plan and was hit with taxes and penalties. Today we're talking about ways to reduce your financial risk so that you can retire with an overall confidence. So what are some things that happen in retirement that are unforeseen or unknown that we can help guard against? And the answer to that is they happen. There's only so much we can do from a math standpoint to predict income and assets and growth and those types of things. But some things that happen in retirement are air conditioning units blowing, roofs that happen to need repair or replacement that are large expenses. A child needs help. Those are very, very common things that we see that come up in retirement, and they're not part of any traditional plan. So what we have to do is make sure that there's enough money that's set aside in some different accounts that people can get to very quickly, that if they need to, that they can get to that money. It's not tied up behind any wall, and that they do have full access to it. Some financial risks that lead up to retirement and the estate planning side would be that people do not have updated estate planning documents, where they want their money to go to from a beneficiary standpoint, or the beneficiaries have not been updated or even added to accounts. It becomes a very big deal when there is an unforeseen thing that happens, like someone passes away. People learn very quickly about the probate laws, about taxes, and about how assets do or do not transfer to individuals that they want to. An estate plan should be reviewed or updated typically whenever you're going to meet with your advisor. An advisor will look at and say, okay, everything looks great. It's very quick to just double check and make sure we have the correct beneficiaries. But whenever there's a life-changing event, someone gets married, someone passes away, someone retires, there's a big financial gain or loss. Those are great times to take a look at things and make adjustments. People in their earlier years of working, I would suggest always to have some sort of life insurance, whether it be term insurance or permanent insurance, some sort of insurance that no matter what happens, the survivor or whomever is left does not have to work so hard. As you get older throughout retirement, those insurances will still work, especially if you have children under the age of 18. And then as you get through retirement, approaching retirement, those types of insurances could also be used as assets for retirement, because some of them will gain cash value. And into retirement, then we look at long-term care planning. A lot of times that gets talked about and should be talked about probably age 50 forward as far as long-term care planning, but it's very, very serious. There's a lot of momentum behind it right now because we're all living a little bit longer, and the long-term care expenses are building, and they are a very, very big expense that could potentially ruin or just crush a financial plan. Insurance could become no longer necessary when people could, in essence, self-insure once their assets have reached a certain point and insurance doesn't matter. I would typically always tell people to keep it depending upon the cost. If the cost works and it works in the budget, it's always a good tool to have. And one of the main reasons is because insurance is not taxable. So there are some advanced strategies that we use where we implement insurances because of taxes and tax implications that could potentially happen to people. Retirement accounts were designed to be an avenue for you to put money into while you're still working. So while you're still working, you're typically making your salary, and then ultimately you want to make more money, and then when you retire, you're probably in your highest income earning years, but you'll also be in your highest tax bracket. So when you retire, that is when these plans shine, because you will be in a lower tax bracket, and that's when you will typically start drawing money from these investments. You have to make sure that you work with a tax firm that understands both the finance and tax side of things, so that when you take distributions out, everyone knows what's going on, so that the appropriate amount of taxes are withheld, so that you don't have a huge tax bill at the end of the year. What we find out a lot of times is the client gets stuck in the middle. They have a financial advisor, and then they also have a tax accountant. So they talk to their financial advisor and they want to take out a withdrawal from their retirement account, which he takes care of. Then they go to talk to their tax accountant around tax time and they owe a few $1,000s in taxes. And the tax advisor says, well, you took money out of your retirement plan. And the client says, well, I didn't know that I needed to withhold taxes. So these two people generally don't talk to each other or know each other. But what happens is ultimately the client gets stuck in the middle because the tax accountant is not a financial advisor and the financial advisor is not a tax accountant. So some things that are super important are to make sure that you have people that are working together to be able to see all aspects of your financial plan. We operate under one umbrella so that we can offer both the tax and the financial services piece. When someone comes into our office, we can tell them typically within $1 of what a transaction would be like, especially into retirement. So if someone was to take money out, we would be able to instruct them on their withholdings, their federal and state withholdings, and then ultimately when to draw that money out. Should we take it this year or can we straddle it over 2 tax years? What makes the most financial sense to them? Limiting your tax liability in retirement takes on a few different angles. If you have assets that you are growing and those assets have done very well, then there are strategies where we might pull money out sooner than later, because at certain ages, at age 70 and a half, they're going to force money out. So you may want to structure a withdrawal earlier on versus waiting so that we don't create kind of a tax bomb that goes off when someone turns 70 and a half throughout the rest of their life because they're forced to take money out that they don't necessarily need or want. Today we went over strategies to reduce your financial risk. And after today, you may realize that you need to update your estate plan or that your taxes may need a second look. At Dobbins Wealth Management, we can help with both. We can sit down for a complimentary tax review and also look over your estate plan and current investments. So book an appointment today. Let's get you a holistic picture of your accounts.